So when we dive into the research for today's deep dive, there's this like massive, almost obsessive focus among business owners on timing the market.
Oh, absolutely.
Okay, they're always watching interest rates, monitoring industry multiples, and just, waiting to perfectly catch that exact peak before cashing out.
Yeah, I mean, it's the ultimate dream, right? Buy low, sell high, perfectly time your exit with a red-hot market. But the data paints a much more sobering picture.
Right. And okay, let's unpack this. Our mission today is exploring why having that perfect market timing is completely useless if you aren't actually exit ready. It's the hidden cost of delayed exit readiness.
Yeah, and what's fascinating here is a specific case study involving a private equity fund. So they had this portfolio company in the logistics sector.
Yeah.
And the market was just absolutely on fire. Valuations were peaking and multiple strategic buyers were circling, meaning, larger companies were looking to acquire them for operational synergies. By all accounts, a perfect time to exit.
It's like trying to list your house at the absolute peak of the real estate market, but you realize the roof is caving in and you haven't even painted.
Exactly.
Like, what was actually wrong with this company?
Well, almost everything that matters to a buyer was broken. I mean, the financials just weren't investor ready.
Right.
The management team had never really been stress tested without the founders heavily involved.
Yeah.
And the most critical client relationships. They were tied personally to the founder. Plus, their operational systems were entirely undocumented.
Wait, but a private equity firm has endless capital to throw at problems. I would think they could just hire an army of consultants and blitz through the prep in a few months. Why didn't that work?
Because you just can't fake time when it comes to structural readiness. I mean, they halted the sale and spent a grueling 12 months just trying to build a proper data room.
A whole year.
Yeah, a year, just to get that secure central hub of financial and legal documents that buyers require for due diligence. They had to stitch together a coherent growth story from scratch because their records were just such a mess.
But 12 months is an eternity in economics.
It really is. By the time they finished getting the house in order, the market had cooled, interest rates had risen. They completely missed their window and had to settle for a multiple 30% lower than what they could have commanded a year earlier.
Ouch.
Yeah, that delay cost them tens of millions of dollars.
Wow. Okay, here's where it gets really interesting. A lot of owners assume they can just hustle and prep everything in 6 months. But looking at this brutal math, why does this structural readiness actually take so long?
Well, it comes down to human behavior and institutionalizing knowledge. Cleaning up financials and documenting operations takes 6 to 12 months because you are literally rewriting how the company functions daily.
Yeah, that makes sense.
And building and stress testing a credible management team, that takes 12 to 24 months. Because leaders actually need time to prove they can steer the ship without the founder holding the wheel.
And I imagine those client relationships are the hardest part to untangle.
Oh, absolutely. Transferring personal client relationships so they belong to the company takes 18 to 36 months. It requires profound behavioral change.
Right.
You have to systematically introduce new account managers, step back from daily calls, and prove to the client that the value comes from the company's systems, not just the founder's personal cell phone number.
So when you stack all those up, a 6-month sprint is just a complete delusion.
Yeah. If we connect this to the bigger picture, meaningful exit preparation requires 24 to 48 months of deliberate work. If you wait until you see favorable market conditions to start getting ready, you've already missed the opportunity.
So if a 6-month scramble is basically a mathematical impossibility, how do you bridge that 2 to 4 year gap without a crystal ball?
Yeah.
Like that PE fund had to either take the 30% hit or hold the asset for another 3 to 5 years waiting for the next cycle, right?
Yes, and they took the hit, regretting it for years. To avoid that trap, the solution points to continuous preparation, specifically getting transfer ready by succession strength.
So what does this all mean in practice? It sounds like you don't wait for the market, you just follow a structured journey.
Precisely. You start with a business transition risk diagnostic, just to identify the immediate gaps.
Okay.
Then you move into the full business transition readiness assessment. That gives you decision-grade data on your leadership, operations, clients, and governance, so you know exactly how long your prep will actually take. And finally, you enter the advisory phase to fix those gaps proactively.
So that when the market does peak, the baton is ready to be passed seamlessly. So as you look at your own exit timeline, don't wait for the window to open. You can start that journey by visiting successionstrength.com or emailing info@successionstrength.com to discuss your exit timeline. And be sure to follow our show for more deep dives.
And This raises an important question to leave you with. Think about your most critical client right now. If you stepped away tomorrow, would that relationship hold strong, or would a massive chunk of your business's value walk out the door with you?